Every politician in the world talks about growth. They're always talking about how GDP was up this quarter or this year, or how the economy expanded or the markets hit new highs, but nobody talks about how that growth was created. Because if your business did $1 billion this year, but you had to go $2 billion in debt just to do it, is that really growth or is that just leverage? Because using leverage can make an economy look incredibly strong, but eventually cheap money runs out, and by the end of this video, you'll understand how debt and leverage expose how economies can look strong on the surface while being fragile at their core. So let's start with what leverage actually is. Leverage is simply using borrowed money to invest instead of only using your own. And you see it everywhere in everyday life. Imagine you have $50,000 and you want to buy a $500,000 house. You put down your $50K and you borrow the other $450,000. That means you're leveraged 10 to 1. Now imagine the house goes up to $550,000. You just made $50,000 on your $50K. That's a 100% return. If you'd paid cash for the whole house, that same $50,000 gain would only be a 10% return. That's the upside of leverage. It amplifies gains. But it also amplifies losses, because if that same house dropped to $450,000, you've lost $50,000, and that's basically all of your equity. And if it drops to $400K or below, you're underwater. You owe more than what the house is worth. That's leverage. It magnifies everything. And when times are good, leverage makes you rich. And when times are bad, leverage destroys you. So now that you understand leverage, it's easy to see how it creates bubbles. Because when the economy feels stable and volatility is low, people get comfortable borrowing and lenders get comfortable lending. So they start lowering their standards. Back in the year 2000, the average down payment on a risky mortgage was about 13%. That's roughly 7 to 1 leverage. By 2006, that same down payment had fallen to just 2.7%. That's 37 to 1 leverage. So why did lenders allow that? Because house prices kept going up, and as long as prices were rising, even risky borrowers could refinance or sell if they got into trouble. So nobody was worried, and more people borrowed and more people bought homes, and demand kept going up and prices kept going up, and that reinforced the belief that housing was invincible. So the cycle kept feeding itself. But the problem is, the more leverage you stack into the system, the more fragile it becomes. Because once something goes wrong, once prices stop rising or even start falling, everything breaks at once. And that's exactly what happened in 2008. And a lot of people, they couldn't understand at the time how $500 billion in subprime losses could turn into a global financial crisis. But we know it has to do with leverage. Because when home prices started falling in 2007, subprime borrowers couldn't refinance anymore. So they started defaulting. Then banks holding those mortgages or mortgage-backed securities, they started taking losses too. But here's the key. Those banks, they weren't just holding mortgages with cash they had in reserves. They were also leveraged 30 to 1. That means a 3% drop in asset values wiped out 100% of their equity. And when a bank's equity gets wiped out, it has to deleverage, which means it has to sell assets to reduce its debt. Now imagine dozens of banks doing that at the same time. They all start selling massively at the same time, which causes prices to fall further. And those lower prices create new losses on everyone else's balance sheet, which forces more selling, which pushes prices down even more, and that's a fire sale and it feeds on itself. If one bank sells an asset at a massive discount just to raise cash, that discounted price becomes the new market price. Now every other bank holding that same asset has to mark it down to that lower value, which creates losses for them, which forces them to sell, and the spiral continues. Without leverage, a 10% drop in prices is painful, but it's survivable. But with 30 to 1 leverage, a 3% drop wipes you out completely. That's why small shocks become systemic crises if all your growth is based on leverage. And before the 2008 crises, bank leverage was insane. Barclays Bank had a debt-to-asset ratio of 95%. That means for every $100 in assets, they had $95 in debt and only $5 in equity. US investment banks like Lehman Brothers and Bear Stearns were leveraged 30 to 1 or more. So why were they allowed to take that much risk? Because banks were holding massive amounts of mortgage-backed securities financed with short-term borrowing. And because investment banks weren't subject to the same regulations as commercial banks, they operated in what's called the shadow banking system. Basically, they had less regulation and more freedom to pile on debt. So they loaded up on leverage to maximize returns. And remember, when the economy is doing well, leverage makes you rich. But when it's not doing well, it can bankrupt you. When Lehman collapsed, it had $640 billion in assets. But because it was so leveraged, even small losses wiped out all of its equity. And Lehman, it wasn't just some small isolated company, it was deeply connected to every major bank in the world. So once it failed, panic spread instantly. Banks stopped trusting each other, the overnight lending market froze, credit markets seized up. That's when the global financial system came within hours of complete collapse. The reason Lehman's failure was so devastating is because banks are interconnected. They lend to each other, they trade with each other, they hold the same type of assets. So when one bank fails, it doesn't just hurt that bank. It creates losses for everyone connected to it. And when banks realize that other banks might be in trouble, they stop trusting each other. That's exactly what happened after Lehman. Banks became terrified of counterparty risk. Basically, what if the bank I lend to collapses tomorrow? So the interbank lending market completely froze. That's the market banks use for short-term borrowing just to keep day-to-day operations running, and once that froze, credit stopped moving. That type of mindset in the financial space was like a disease, and it spreads fast. Because in a highly leveraged, interconnected system, no one really knows who's solvent and who's about to fail. So everyone assumes the worst. So banks stop lending, then businesses can't get loans, then consumers can't borrow, and spending collapses. And when credit stops flowing, the entire economy seizes up. And that's the fundamental problem with leverage. When an individual investor or bank takes on leverage, they only consider their own risk. They think if things go wrong, I'll lose my money and that's my problem. But they don't consider the systemic risk they're creating. When they're forced to sell, they push prices down for everyone, which forces other leveraged investors to sell too, which pushes prices down even more. Financial stability is a public good. Everyone benefits from it. But individual operators, they have no incentive to contribute to it. They get the upside when leverage works, and when it blows up, the cost gets spread across the entire economy. And it's exactly why financial crises keep repeating. And the worst part about it all is that being over-leveraged, it doesn't just create fragility, it creates the illusion of prosperity. When the government borrows and spends, GDP goes up and the economy looks strong. But that growth is artificial. Right now, government spending makes up about a third of GDP. And recently, we've seen quarters where government spending jumped 3.4%, then another 1.9% right after. Meanwhile, private investment was negative for 3 straight quarters. So what we have is massive government borrowing propping up GDP. But the underlying economy is weak. This is debt-fueled growth, and it looks good on paper, but it's not sustainable. From 1950 to 1980, the US averaged over 7% annual GDP growth with much lower debt levels. Today, we need double the debt just to get 2 or 3% growth. So each additional dollar of debt produces less and less economic growth. That's a huge warning sign. It tells you the system is saturated with debt and you can't keep this going forever. And corporations are doing the same thing with stock buybacks. From 2008 to 2017, 466 of the S&P 500 companies spent $4 trillion on buybacks. That's 53% of their profits. In 2018, more than half of all buybacks were funded with borrowed money. Companies are borrowing money to buy back their own shares because it inflates earnings per share. And when you reduce the number of shares, profits get divided among fewer earnings, so earnings per shares go up even if total profit stays flat. This makes the company look more profitable on paper, and it makes the stock price go up, but it's financial engineering. It's not real growth. And here's the sneaky part. Corporate executives sell 5 times as much stock in the week after a buyback announcement compared to normal periods. So they're using insider information to inflate the stock price, then they're cashing out. Meanwhile, the company is left holding more debt. Even recently, companies like Apple, Microsoft, and Meta have spent hundreds of billions of dollars buying back shares. That's money that could have been invested in R&D, worker wages, or reducing debt. Instead, it goes to shareholders, and much of it was financed with borrowed money. This creates the illusion of prosperity, but it's built on leverage. Look, the point of this video is not to say that all leverage is bad. Leverage is powerful when it's used intelligently. And it's something that me and many Americans use in our lives. But you don't need massive amounts of debt to grow an economy. You need strategic debt, productive investment, and real underlying demand. Some countries use leverage carefully, and a great example of that is Singapore. They borrow to build infrastructure, improve productivity, and strengthen their long-term economy. The problem is when leverage is used to inflate asset prices or manufacture growth that isn't really there. That's when economies start looking strong on the surface, but they're really fragile underneath. And why this matters is because politicians will always show you GDP numbers, corporations will always show you earnings, markets will always show you new highs, but none of that tells you how much debt was used to get there. And now that you understand leverage, you can stop taking growth headlines at face value. And you can start asking better questions like, where is the growth coming from? Is it productive or debt driven? Is it sustainable or engineered? And just having that understanding already puts you ahead of most people and allows you to make better financial decisions for your future.